Welcome back to the 90s podcast hosted by yours truly, Kevin Thompson, founder and CEO of 99 Capital Group. Thank you guys for joining us. As I always say, subscribe to the channel. As I always say, go and get my book, MLB to CFP, live on Apple and Amazon. If you have any questions, comments, or concerns, you can email us at info@99capitalgroup.com. Send us a question. Go to the website at www.99capitalgroup.com. Schedule an appointment. As you know, we're here to do what? Educate, empower, engage, and also entertain. And today we're talking about the executive order that just passed. Private equity, private credit, and crypto. Should they be in your 401k? We're here to explain what's happening, why it's happening, and our thoughts on the matter. Let's get it. So I'm going to be real with you. On the surface, this sounds like a great opportunity, more investment options, potentially higher returns, and access to strategies once reserved for the quote-unquote high net worth, the institutional investor. But is it all it's cracked up to be? Let's break this down into 4 parts. We're going to define what these investments actually are, why they're moving into the 401k plans, what you need to consider before jumping in, and also my opinion on whether they belong in your retirement account. So let's start here. Let's talk about what we're actually discussing, right? Private equity. What is private equity? Private equity is the ownership of companies that are not publicly traded. Private equity funds pools of investors' money to buy, restructure, and hopefully grow companies and then sell them for a profit down the road. The returns can be large, but so can the risk. And the timeline, often 7 to 10 years before you see actual results. Private credit, on the other hand, this is lending money directly to companies without going through the public bond markets. Think of it like being the bank for the business that can't or won't borrow from traditional lenders. Yields can be higher than traditional bonds because you're taking on more credit risk, and often these loans are very illiquid. And third, let's talk about the crypto. Digital assets like Bitcoin and Ethereum, they run on this thing called the blockchain technology. Crypto is very volatile. If you're not familiar with it, it's very volatile, speculative, and unlike stocks and bonds, it's not necessarily correlated to that. It's not tied to any underlying cash flows or anything that's of actual value. It's also traded 24/7 market and with wild swings that can be extreme in both directions. You guys have seen it. We've seen Bitcoin go from 100,000 down to 16,000, back over 100,000. It's incredibly volatile. So why are these funds or these investment vehicles moving into your 401k? That's the question. I've been hit time and time again with people trying to sell me on why these things are needed, why you need private credit, why you need crypto, why you need these types of outside investments, and why it is powerful for returns. There's a big push from asset managers to get these into retirement accounts, and here's why. One, they want to give you access to alternative strategies. Traditionally, PE, PC, and crypto were only available to institutional investors. Well, not quite crypto, because crypto you can buy it on, all these different exchanges. But these PE and PCs have always been available to institutional investors and high net worth individuals. Opening the door for 401ks gives them a huge pool of new capital, mainly new commitments. These investment vehicles need new commitments to fund their new investments. And the 401k gives them a huge swath of capital to do so. Next, it widens the investment moat. Fund managers now are considering using your 401k dollars to put into these vehicles. And they know once your retirement dollars are in the strategy, they've got you locked in for years, sometimes maybe even a decade, which is very different from a daily liquid fund like an index fund. Next, the fee revenue. I'm going to be brutally honest here. A lot of this is driven by fees. A typical index fund might cost you 3 to 10 basis points. Private equity, private credit could easily be 100 basis points. Again, I don't know how it's structured as of yet. There hasn't been any necessarily insight on what the actual investments will be, whether it be a fund of funds or maybe you're invested alongside some institutional manager. but these will be highly more expensive than your traditional investments. Plus, how they're structured, they have performance fees embedded inside of them. So I'm not going to get into the GPs or the LPs and all the other stuff because that can get really convoluted, but I'm keeping it very high level. It's just a huge difference in what the managers make. They're getting access to a swath of trillions of dollars of capital by which to invest. And lastly, the performance pitch, right? They'll point to historical outperformance over public markets, but keep in mind, those returns often come with less transparency, higher volatility, and much more risk. So what should we consider before investing in these types of investments? If these investments land in your 401k, again, it's going to be up to the fiduciary and the plan sponsors to see if they fit those what the plan administrator and what the 401k participants need. So it's up to the advisor of the plan and or the plan administrator to make those recommendations or put those inside the plan. So just to square one. Liquidity. Unlike stocks and bonds, you can sell quickly. PE and PC lock up your money for years. That's fine if it's a small slice of your portfolio, but it can be a problem if you need to rebalance and access funds. 2, the fund structure. Are you invested in a diversified fund of funds like I mentioned before, or just a single strategy? A broad allocation may reduce the risk, but could also dilute potential returns. 3, manager selection. With alternatives, the manager matters more than an index fund. Top-tier managers may outperform, but average managers may underperform the public markets, and you still pay the high fees either way. There's a cost to carry inside of these things, management fees. It's just the list goes on and on. You have to understand the actual investment. Next, valuation transparency. Public stocks have a market price every second. Private valuations, equity markets, especially private equity, private credit, are often based on appraisals or estimates, possibly once a month. So it can be very subjective into how your fund is actually doing. And of course, we mentioned volatility and risk profiles. Crypto can drop 30% in a matter of months, right? We've seen massive moves in the crypto space. We've seen massive moves in all these different illiquid investments. Private credit can look stable until defaults rise. Maybe there's a rise in interest rates. Again, we're not expecting that, but there's a lot of things that can possibly change the returns of private credit. Understanding risk is just as important as chasing returns. So the main purpose of this is because I want to tell you where I land on this type of investments inside of 401ks. In most cases, I don't think these things belong inside of your retirement plans for the average investor. If you want to invest in these types of things, you can also do it outside of your accounts. Now, as they're sold as alternative strategies, uncorrelated asset classes, diversified vehicles that are going to reduce your overall risk to your portfolio, right? But again, it's important to understand how this works. Now, I'm not going to get too technical here, but this is how my brain works. There's this thing called the risk-free rate. The risk-free rate is designed off the 10-year yield. Right now, 10 years yielding over 4%, 4.2%, what have you. So these are investments like treasury bonds, treasury notes, treasuries that are 100% backed by the United States government, full faith and credit. So if you put $1 in those investments, you typically get $1 plus the interest rate or plus the, if it's a treasury, you buy them at a discount. So there's opportunities there where there's very little risk of default, quote unquote. But when I look at these investments, I look at them as a risk-free rate versus expected return. Right now, like I said, you can get 4 to 5% inside of those treasuries with virtually no risk. For PE and PC funds to be worth the illiquidity and the higher risk, I want to see an expected return of at least 3 to 4% above that net. Quite frankly, when you look at these returns, if let's just say hypothetically, one of these funds gives you a 14% return, right? Now, the GP takes their fees, they pay out the limited partners, they take their management fees outside of it. Maybe it's 2 and 20, however that looks. But then depending on the type of investment it's inside, if it's a fund of funds, now the fund manager inside of that account wants to get their fee as well. The net fee, when it's all said and done, has to be 3 to 4% higher of an index fund just to justify the additional risk. And it's very difficult to imagine that they're going to be beating the index 3, 4, 5, 6% just to justify the additional risk and the liquidity cost. Next, let's talk about the cost. When you compare 100 basis points in fees to 3 to 10 basis points for an index fund, you're starting in a hole. Over decades, that fee is a massive drag. That could cost you significant returns over a long period of time. Again, if you're charging me 100 basis points, but yet I can get between 3 and 10 basis points on an index fund, what is the expected return I'm going to need to even justify to take that risk? It's going to be substantially higher, especially if the risk-free rate remains at 3 to 4% or 4 to 5%. Now, like I mentioned, true returns, the pitch decks will show double-digit returns, but net of fees, bad vintages and underperforming managers, the actual realized returns can be as closer to the market than you think. If you can get 7 to 8% in a diversified stock index fund for a fraction of the cost, why take any extra complexity? That is my 2 cents. And finally, crypto and retirement plans. This one's easy for me. For most investors, it's way too volatile for a core retirement allocation. If you want to dabble, do it outside your 401k with a small portion of an overall portfolio, that's fine. Again, I'm not giving you any recommendations here, but I'm saying keep this separate to what's currently happening inside your 401k, because your 401k is meant for retirement. So bottom line, if you're a sophisticated investor with a clear plan, these might have a role. But for most retirement savers, the traditional mix of stocks and bonds still offer a better risk-adjusted return, lower cost, and more flexibility. So in closing, before you get too excited about this new investment option in your 401k, ask yourself, do I understand how they work? Do I know the real cost? Am I being compensated enough for the risk that I'm taking? Sometimes the boring choice, like I said, low-cost index funds, is the one that quietly builds the most wealth over time. I hope this has been a valuable use of your time, because I truly believe that these companies are looking for ways to have access to new capital. I'm not saying that it's something that is not needed, but ask yourself this question: why now? Why the rush? And what's the overall purpose? Are you truly giving me access to something that's going to increase my returns 2x, 3x times? Or are these people trying to get returns or get access to my capital because they're looking for liquidity options to fund their next venture? Thank you guys for listening to the 9 Innings Podcast. Subscribe to the channel. Go and get my book, MLB to CFP, live on Apple and Amazon. You have any questions, comments, or concerns, you can email us at info@9icapitalgroup.com. Send us your question. Go to the website at www.9icapitalgroup.com. Schedule an appointment. Follow us on all social media channels at MLB to CFP or at 9iCap. As you know, we're here to do what? Educate, empower, engage, and also entertain. Today we talked about, do we need alternative investments inside of our 401ks? And private equity, private credit, and crypto, is it a viable thing to have inside the qualified account? I don't know. I just know that I know Wall Street well enough to know that there's always a reason behind the madness. Thank you guys again. Stay humble, stay safe. I'll see you again soon.